Today we have a question from Sean. Sean wants to know about health savings accounts and high deductible health plans. Well, this is a topic that's near and dear to my heart because I've had a high deductible health plan with a health savings account for about the past 8 years. So I'm more than happy to explain how these work. So let's take a look at Sean's question and then I'll begin to answer it for him. So here we go. So Sean says, first off, I wanted to say I really enjoy your podcast. Thanks, Sean. I have really learned a lot from you both over the past year or two. I am a recent retiree and I just switched over to an HSA. It's the GEHA high deductible plan. I am new to the whole HSA thing as I had Blue Cross and postal workers insurance for the past 30 years. And I'm not sure I quite understand the benefits of an HSA. Can you discuss the benefits of maximizing the amount of contributions to the HSA and to maximize my benefit in retirement? I'd be more than happy to, Sean. So let's start off with just basically what is an HSA? So a health savings account, or HSA, first off, is different from a flexible spending account. Remember that flexible spending accounts for healthcare or dependent care are strictly for employees only. And they have a use it or lose it feature that at the end of the year, you can only carry over a very minimal amount, and it can only be used by employees, not retirees. So this is different from what we're talking about today, which is a health savings account or an IRA for healthcare, as I like to call it. These partner with a high deductible health plan. So in order to take advantage of a health savings account, you must be enrolled in a high deductible health plan to make these tax-free contributions. So not only are the contributions tax-free, but the money will grow tax-free and you can spend it tax-free when you use that money for qualified healthcare expenses. Now, this money is yours, so if you do want to spend it for things other than healthcare expenses, you can take it out, but you will pay tax and possibly a 10% tax penalty if you do so before age 65. So it's really best to have this set aside for either current or future healthcare expenses, whether it's the co-pays on your prescriptions, whether it's meeting your deductible on the high deductible health plan, or even in the future using these funds to pay for Medicare Part B premiums or even long-term care insurance. So these are different than the qualified expenses for an FSA. So again, another difference. The money that's in the HSA, either contributed by you or deposited by your health plan, all belongs to you. So even if you leave that health plan, that money goes with you. You can either leave it in that health savings account or move it to another HSA account, maybe at your own bank. These accounts earn interest, so they are FDIC insured. They are traditional bank accounts, even though it's usually a virtual bank where you're setting up this money. Now, in addition to that, once you achieve a certain balance, you'll be able to move money into an investment account. Think of it like the TSP, where you'll have choices of mutual funds to choose from, where you can invest this money for future growth. So what is a high deductible health plan? Because remember, you have to be enrolled in a high deductible health plan in order to have an HSA. So first off, we don't like the name, do we? High deductible health plan. That means, according to the IRS policy or rules, you have to have a minimum deductible of $1,400 for self only or $2,800 deductible for self plus one or family to be considered a high deductible health plan. Additionally, the maximum allowance for out-of-pocket expenses, we call this our catastrophic cap under FEHB, is $7,000 for a self-only plan, $14,000 for self plus one, and that can be limited to using only network providers. Under the FEHB high deductible plans, they all contribute to your HSA. They call it a premium pass-through. So they're actually crediting a portion of the cost or the premium that you're paying for these health plans into your HSA account. And by the way, these high deductible plans generally have very low premiums, among the lowest in the federal health program, because typically they encourage more healthy people to enroll. Although the hidden secret is They're not just good for those in good health. These can be also excellent options for those who have medical expenses and have even high medical expenses due to that limit on the catastrophic cap and due to the tax advantage. If you're in the plan that Sean is in, the GEHA plan, the deductible for 2021 is $1,500 for self only and $3,000 if you're in self plus one. But remember, the plan is also crediting a portion of what you pay in premiums to help offset this deductible. So how much can you contribute to an HSA? So for self-only plans for 2021, the maximum contribution to an HSA, which includes this premium credit, is $3,600. For self plus one or self and family coverage, that's a double that amount, or $7,200 for this year. Now, if you're age 55 or above, you can throw in an extra $1,000 in catch-up contributions to your HSA account. Now, in Sean's case, the GEHA plan provides him a $75 a month credit or premium pass-through to start off his HSA account. So they actually contribute for him, and then he can contribute the rest of the money up to the $3,600 limit. Or if he's in self plus one or family coverage, the GEHA plan contributes $150 a month or $1,800 a year. And then again, the participant can contribute up to the limit, which this year is $7,200, plus the $1,000 if you're over age 55. You can deduct this reimbursement from the contribution, and that's how you determine how much you can personally contribute to that account. In the GEHA plan in the FEHB, the maximum out-of-pocket limit for in-network care is $5,000 for self-only or $10,000 catastrophic cap for family. And if you go out of network, which is still covered, you have a cap that's a little higher at $7,000 for self-only or a $14,000 catastrophic cap for out-of-network care in the GEHA high deductible plan. Now, this slide came from the GEHA website as an illustration of how these funds, this money that you contribute, the GEHA or the health plan puts into your account, how that can grow over time. It's showing over 1 year, 5 years, 15, or even 25 years of this money accumulating earnings and compounding, just like your TSP or other investments, how that money can grow over time. If you look at the last one on the right, you can look at all three, but for right now, I'll illustrate the one on the right. Here's someone who's saving $900. This is a self-only individual getting the $900 GEHA contribution to their plan. They're contributing up to that limit of $3,000 or $3,600, which means they're putting into the account an additional $2,700. So if that money stays in there over 5 years, 15 years, 25 years, earning a 6% rate of return, which of course we can't guarantee that, but just if it's well diversified in an investment, this is just an example of earning a 6% rate of return. What could be in that account at the end of a period of time? So again, just to illustrate the fact that not only is this a way to pay your out-of-pocket medical expenses, it's also a way to shelter some of your current income from taxes and allowing that savings to grow on a tax-free basis. Hard to find something like this anywhere else. So how do you set it up? If you enroll in a high deductible health plan, your FEHB plan will set up the HSA for you. Now, if you're not eligible for an HSA because maybe you have Medicare or TRICARE, or maybe you're covered under a spouse's private sector health plan, then they're going to establish a health reimbursement account or an HRA for you instead. So remember that the only way you can make contributions to an HSA is if the high deductible health plan is your only insurance. So that's kind of important to remember. Now, when you enroll in this plan during open season, the plan itself will take effect in January, just like any other federal health plan. It may take another month for the health plan to really establish this bank account, this HSA account for you. Once it's established, they'll contribute their premium pass-through every month. You'll then be able to make your tax-free contributions to the account as well, either through payroll deduction if you're still working, or you can contribute through your bank account as a regular allotment, or you can even just mail in a check. But I like the idea of having it come out of my bank account automatically so I can maximize my savings and try to contribute the full amount during the year. When you're paying for expenses, you can pay for those expenses using a debit card, or you can use online banking to pay those bills that come in the mail. You also can pay your bills out of pocket and reimburse yourself from your HSA account. Just save your receipts. To learn more about the eligible expenses for this account, you can see IRS publications 502 and 969 that talk about qualified medical expenses, health savings account, as well as HRAs or health reimbursement accounts. GEHA is not the only FEHB plan that has this option. You can also check out Aetna, MHBP, United Healthcare that all have high deductible health plan options as part of their family of different plans. You'll also find throughout the country there's several others that are more regional plans, and these can be found whenever you visit opm.gov/healthcare/plan-information, and you can find those plans there. So check out a high deductible health plan for maximum tax savings. Until next time, this is your FERS Federal Fact Check.